So, good morning, dear listeners, and welcome to our first webinar for 2022. We extend a warm welcome to you, and by warm, I don't mean it lightly. Taking the temperatures we've experienced the last few days here in Cape Town, suppose a cold shoulder might be a bit more comforting. But in any case, best wishes for the year. We hope you'll all have good health, and hopefully by the end of the year, we can all forget this mask wearing story. Hopefully we can see a few crooked politicians in orange jumpsuits this year. And best of all, I hope you will make wise investment decisions this year. As always, the investment environment looks challenging going forward. I'm Hare. I'm sitting in our Prescient offices in Westlake. The beauty of technology, of course, joined by Bastian and Rupert from the multi-asset team, sitting downstairs in our fancy studio. And Davy Carstens is managing our tech side from Stellenbosch. So our agenda today will cover just looking back at Omicron, the impact that had across the globe and specifically to markets and in SA. We'll do a bit of an analysis on the global macro environment, take a deep dive into inflation. Inflation is obviously at this point in time front of mind, very relevant potential driver of global macro impacts on markets. And then we'll do an update on our views on asset classes. But before I hand over to Bastian and Rupert, maybe just like to touch on a few industry buzzwords and just kind of take an analysis, so a bit of understanding on how we as a systematic investment manager view some of these concepts. Now, one of the words that we kind of hear quite a lot in our industry is trust, and we all appreciate that when you deal with someone's money, trust is a key ingredient of that whole arrangement in managing money. So obviously, all asset managers will go out and tell you that they handle your money with the utmost of trust and care. Another word we hear often is risk management. Now, risk management can really mean a lot of things. Depends on how you define risk. I mean, if you define risk as the risk of being the top performer in asset class, then by managing your money poorly, you're managing risk. So one needs to be always cognizant of the way you manage risk. Superior returns is another one. I mean, I can't see any manager going out promoting their inferior returns. So everybody tries to illustrate that their propositions is geared towards delivering superior returns. And consistency is the last one I want to touch on. And obviously, again, a great buzzword. I mean, some managers have their slogans around consistency. But at Prescient, we like to understand a bit deeper the true meaning of consistency. Because consistency is obviously important to clients because it creates some measure of predictability and anchor expectations based on consistent past performance. So we thought we did a little exercise to analyze the multi-asset high equity sector, and we wanted to determine whether managers can outperform the sector consistently. The reason why this is an important topic to us is we said all along with the Prescient Balance Fund, we believe that if you can consistently over shorter periods outperform the median manager, you'll drift up towards top quartile over longer periods. Now, we all know investments, especially in funds where you have meaningful equity exposure, is a longer term game. So we took the 200 odd funds currently in the multi-asset high equity sector, took all funds with a track record of 3 years or longer, and we checked how many of these funds outperformed the median on a rolling 12-month basis. And the results were quite interesting. What we found was that only 7.5% of all these funds in this sample that we looked at, which is the sector, outperformed the median of the multi-asset high equity sector 75% of the time. Now, that's a mouthful, but what it really means is a very limited number of funds managed to consistently outperform the peer group. Obviously, in this exercise, we also discovered, as we expected, that the Prescient Balance Fund came out tops. It outperformed the peer group 88, nearly 89% of the time. So if history is anything to go by, one would expect that you invest in a Prescient Balance Fund looking forward, you're going to be above average, above median, 75% of, or 88% of the time above median. But more interesting is, then we looked at longer periods, and this you'll also see that when Bastian and Rupert talk about historic performance. If one extends this 1 year rolling period to 5 year rolling periods, which we believe is a reasonable time to evaluate a balanced fund over, you'll find that over the 32 5-year rolling periods that we've been managing the Prescient Balance Fund, 100% of those 32 periods we've outperformed, not just outperformed the median, we've been in the top quartile of the median, and 23 times out of the 32 times we're in the top decile of that peer group. So again, if history is anything to go by, one can deduce that if you invest in the Prescient Balance Fund, you've got a very good probability of going forward over rolling 5-year periods, end up in the top 10% of this huge peer group. Now, that illustrates consistency numerically. It's not just lip service, but it also illustrates risk management, which is another buzzword. So risk management relative to the peer group is incredibly important characteristic to embed in your investment process. And that is what we are about. We are about managing your risk, but also delivering you competitive returns. And that's hopefully the message that Bastian and Rupert will instill with you today. So we hope you find it meaningful. We hope you find some snippets of wisdom in there. We're also going to run a number of poll questions during the webinar, just to kind of get a feel for the view of our audience. So at this point, I'm going to hand over to Bastian and Rupert to take their presentation forward. So thanks for joining us, and I hope you enjoy.
Thanks, Mayor, for the intro. And yeah, first of all, thanks to everybody for joining us once again. Really appreciate it, and always good to have this interaction. So yeah, we heard a lot about numbers already. Unfortunately, if you listen to a Prescient webcast, it's not going to get better. We're going to continue with some stats, but please don't worry. We will make it very interactive and obviously link it back into the environment which we're dealing with. Just a very brief intro, but I'm not going to spend more than 5 minutes on that, on Prescient's investment philosophy. So we all know that we are a systematic investment house, and we really want you to think Prescient if you think about systematic investing. And if you hear systematic investing, you must think Prescient. And if you hear Prescient, you must think about, oh, that means systematic investing. So what does systematic investing mean? It's rational, it's rules-based, it's evidence-based. We go by the numbers, as Maya already said in the beginning, and we really trust that we need statistical evidence in our statements, in our market views. Otherwise, what are they worth? We are very data-driven. We process more than 100 million data points every day, which is a lot. We claim it's the most data points processed from any asset manager in South Africa. So we do think that we don't only have unbiased decisions and clear strategies, but that we do get a natural information advantage. And that's really what we're aiming for. We've got a very smart team, an investment team with roughly 30 people strong, and everybody in this team is geared towards a strong economic, but also a strong mathematical background. Okay, so we're achieving long-term consistent outperformance with this investment approach. And yeah, again, we go by the numbers. Consistency is an overused currency in our industry. Very inflationary, speaking about inflation, very inflationary term, which is overused. And that's why we actually want to prove, and we'll do it once again during this presentation, what we think consistency really means. Okay, so first of all, I want to just start off very quickly by saying once again, investment policy dominates investment strategy, explaining on average 95.6% of the variation towards portfolio return. So we had that already the last times, which just means asset allocation matters. Okay, so we all like to focus on fancy stock picking stories, but there's academic research which shows 95.6% is driven by asset allocation. So focus on asset allocation, not on stock picking. We are active within the asset classes. We are active within the asset allocation framework, be it tactically and be it strategically. But you have to look long term, and you have to make sure that your interesting stories. I also like to speak about Tesla and Naspers and those things, but it's just not definitive of your investment success. Okay, so just what are we trying to achieve? And I'm just showing what 2 or 3 charts for that very quickly. We've shown these charts before as well, just updated. So in red, you can see the average South African multi-asset income fund, and in blue, you can see the South African multi-asset equity fund. Last time we spoke, the income fund outperformed over a 5-year period. Now you can see that the balance funds have taken over, but nevertheless, the journey with the balance fund over the last 5 years has been slightly more volatile. Again, these are not prescient products. We're talking about the average fund in the CISA categories, multi-asset income and multi-asset high equity. Okay, so that's 5 years. That already in itself shows you, I mean, you're avoiding drawdowns of like more than 20% if you would have just switched to income at the right point in time. So trying to say asset allocation is just far more important than stock picking. No stock pick would have saved you from a 20% drawdown once COVID hit. Okay, let me go to the same chart, but now we're extending the time window to 20 years. So over a 20-year period, a same picture, we once again picture the South African multi-asset high equity balance funds against the South African multi-asset income fund. If I move very far to the right of this chart, you can see that there's 400% outperformance amongst the balance funds against the income funds over a 20-year period, which is not that long. So bear in mind, asset allocation matters. You need the right strategic asset allocation. Your tactical tools matter as well. We all want to generate within asset class alpha, and we do that through portable alpha, but don't get lost in clever stock picking stories. Okay, so now we've established, okay, you need a high equity balance fund with the right asset allocation framework. So we obviously claim we would deliver on that, but the difficulty which we are facing is there's a massive dispersion amongst the balance funds in the CISA multi-asset high equity category. Maya mentioned already earlier that we have more than 200 funds in this category, which we've all depicted in gray here. And then in blue, you've got the balance fund. So yeah, the balance fund has a great track record. We moved quite close up to the top here, easily in the top 10 amongst all the 200 funds that you just mentioned. But for us, again, it comes down to consistency. So what we really want to achieve is more this chart. So in this chart, what we're showing is the 1-year rolling outperformance ahead of the average fund in the category. So this dark blue line is basically highlighting how we have ranked. If we are at the top, we are the #1 fund in the category over a 12-month period. If we are at the bottom, we are dead last. And then those dotted lines are just highlighting the 25th and the 75th percentile. So if I now just pick any fund in this category, which will now just come up in red, you can see that a lot of the funds will experience quite volatile journeys. Okay, so normally most of our peers would go from the top to the bottom, from the top to the bottom. And that's what some of these funds do. There's not necessarily anything wrong with it. These can be outperforming strategies. So there's no statement that this is necessarily a bad investment strategy, but it's not our investment strategy. So our investment strategy is exactly what you can see in the blue line. We are basically never going into the last quartile and very seldomly going into the third quartile. And then we achieve a high level of consistency in the first and second quartile. If you now extend the time period to 3 years rolling, you can see that we've got almost 100% hit ratio in the first quartile over 3 years rolling since inception of our fund. And if I go 5 years and go do later in the presentation, that picture becomes even stronger. Okay, but we're not going to talk too much about performance in the intro. Let us rather go to another chart highlighting how we achieve this consistent outperformance. Strictly speaking, over a 12-month period, we're almost always better than average. And I always like to quote Michael Jordan, and again, that I've done before as well. He said, all he knew in life is that he never wanted to be average. And we also don't want to be average. So I actually don't like to talk too much about an average fund and that it's such a great thing to beat an average fund. It's not. It comes down to the consistency. So always beating an average fund, that's a great achievement. And that's what takes you to the top. And most importantly, it takes you to the top in a very pleasant way because you don't experience the turbulences of underperformance. Okay, so how do we achieve it? Because now obviously we've shown the numbers and we do achieve it. So how do we get there? First of all, we blend all the nice attributes of the pure passive strategies with the nice attributes of the pure actives. Why would one buy a pure passive product? We've got low fees, 30 bips in the balance fund. We've got low transaction costs. So our transaction costs are partly lower than the pure passives. And we've got low tracking error. So you can see tracking error for us is that nobody worries about tracking error on the upside, right? Tracking error at the downside is what measures, but you've seen in the previous chart, we never underperform over a period longer than 12 months. Okay, so why don't we just do this and go pure passive? Well, because we do think that we can achieve more consistent outperformance if we do blend in some elements of the active managers. But we are an active manager, and there's a great justification for trying to capture outperformance. First of all, alpha, we do generate portable alpha. We don't stock pick, but we do generate portable alpha. So reporting fixed income alpha on top of our equity building block. By doing that, we can achieve a much higher hit ratio. We've actually outperformed 100% every single year since the fund is incepted. We could port a positive portable alpha on top of our equity building block. But an efficient allocation of capital. So we consistently review, and that's where we actually spend our time in research. We consistently review long-term capital market expectations and assumptions, and we basically feed them through into our dynamic optimization framework to make sure that we are always ideally positioned and efficiently positioned. Last but not least, we are capturing market dislocations. So we do TAA tilts. Right now, we have a lot of TAA tilts in place. We're heavily overweighting SA equities, we're overweighting SA bonds, we're overweighting the rand, just to name a few. We're underweighting developed market bonds. So a lot of TAA trades in place. We are very active. In fact, we do everything active which any other active fund in the balanced space would do. All we don't do is stock picking because it statistically does not work. Okay, so what's the output of this? You get a great result. I'm going to go to this chart again in the end, so I don't want to spend too much time. Maybe for this exercise, we just focus on the left-hand side. On the x-axis, we plot the TIC of all the funds in the category over the last 5 years. On the y-axis, we plot the performance. So where do you want to be? You want to be above the regression line because you want to beat the average. And you want to be on the left-hand side because you want to be cheap. Okay, so where are we? We are right at the top left. So we are charging very, very low fees. In fact, lower than some of the peers, which are pure passives. But you would see that we have actually outperformed these pure passives by quite a bit. You can see that we're just much higher on the y-axis. Okay, so that's basically it from my side for a quick intro, what we're trying to achieve and how we do achieve this. And I'm going to now speak a little bit more about what's driving markets this year. And for that, I'm going to hand over to Rupert. So there's 3 major themes which we'll cover this time. We've covered most of these themes on the chart already last year with you. We're once again going to go into COVID-19 and the impact thereof. We're not going to go into easy financial conditions and inflation again, but we're going to speak about our 2 new themes, strong global growth and the Fed yield curve twist. We can see in gray shaded the steepening yield curve of 2020 and the democratic blue wave. Those themes, we still update the data, we track the backtests, we continue to analyze the implications thereof, but we've put them in light gray here because right now they're not dominant in our opinion.
Thanks, Bastian, and thanks for all of your time this morning. So I'm going to take a step back and just go from a top-down macroeconomic perspective as to how do we get to these building blocks within the model. Bastian mentioned millions of data points. How does that all work? How does the research work? And what are we looking at right now for the multi-asset funds? So of course, we have to start with our old favorite, which is COVID-19. I think we've all almost heard too much of it now. We're sick of it. But it is something which is still on the radar. So for us, it's important to track. How we track that is a couple of different measures. We look here at severity of restrictions, where we're looking at basically the levels of lockdown within 2 major economies, that's South Africa and the United States. What you can see in this chart overall is we've been trending downwards in our severity of restrictions, as has the United States. And that's just analogous with the opening of economies around the world, the lesser severity, it seems, of the new waves of COVID-19, which means that we have had to open the economies in order to bring them back online and to create growth. Where does it stand in the latest wave? So if we look at this chart, you're seeing the daily infection growth rate. That's people per million, so normalized, and that's comparing South Africa versus the USA. You can see each of these waves that we've gone through. South Africa just having experienced the 4th wave and having timed the lockdown or lack thereof extremely well, so that we hit the peak of the 4th wave somewhere around Christmas without having to impose extreme lockdowns in the country, and then have now since gone right down back to a low infection growth rate. What's interesting though is the United States is only just peaking now and have peaked at a much higher growth rate than in previous waves. Why I say that's interesting is that it's almost a non-event, right? So we've had this massive infection growth rate, and yet the severity of those infections has been a lot lower, and the impacts on growth have been minimal. So that's important for us looking forward within the multi-asset offerings to see whether COVID is still something which is extremely important or less so going forward. Workplace activity. So you'll see here we go through phases. There's a dip over Christmas generally, but what we can tell is that we're right back to where we were, the 0 line on changes in workplace activity. In other words, we're back in the office. Things are going as they were before, and we're ready to roll for 2022. Going forward, what we look at here is the vaccination growth rate, or sorry, vaccinations per percentage of people within the population. And here you can see that South Africa, although it remains less than half at the level of vaccinations of the 2 developed market countries you track here, it still seems to be getting through these waves in a much easier fashion than it has done prior. Okay, so that's COVID. I've covered it very quickly. And Bastian is now going to tie in this COVID picture into how that affects growth, which I think is the key within our model. So we look at growth, valuations, and that's what affects asset classes.
Exactly. Thanks, Rupert. So we are seeing 7 good reasons just to be a little bit optimistic here, especially after a lot of talk around COVID once again, which we really feel guilty by now to put you through. 7 strong reasons why we think the global economy, which not necessarily means that every asset class outperforms, but we do see 7 reasons this year to be optimistic on global growth. And Rupert highlighted already the first one being COVID. So I'm going to start by just taking you through these 7 good reasons. So first of all, each and every COVID-19 wave, there's been lesser and lesser and lesser of a drag compared to the previous wave. And secondly, the second point, economic activity has shown to actually bounce back very quickly after these waves. Remember a couple of, like 1.5 years ago, or 2 years ago now, lost time almost, 2 years ago in March 2020 when COVID hit, we had these plenty of discussions around would the recovery be V-shaped or W-shaped or L-shaped, or how will we recover? Is it Y-shaped? So we had all the different alternatives, and we have learned the recovery is V-shaped. We also never necessarily weren't right on that call, but we know that by now, so we have to take that into account. I want to just quickly show this chart. So we're showing just the infection growth rates in the United States, sorry, the daily COVID cases in the States, and basically in the red line, and then in blue we see the consumption expenditure and the percentage change thereof. Okay, so how much does the consumer spend? So what you can see is if you look at this first wave here, that was when COVID first hit, consumption completely collapsed. Okay, so you look at the blue line, we saw this massive collapse in consumption, and would think that, okay, the world was becoming to an end because of COVID. Having said that, after that, we saw far more severe waves, but you can see that consumption was pretty stable. Okay, so consumption was not hurt that much to any extent. I actually go one step further now, switch off the COVID cases and just look at in the shaded area, the areas where we are basically post the individual waves, you could always see a sharp uptick. Okay, after this sharp decline, a very sharp uptick, but even after this second wave, a recovery, after the third wave, a recovery, after the fourth wave, a recovery. So why this should be giving us confidence is, first of all, we can live with the virus, we can deal with the virus. When Omicron was discovered, we didn't even need another lockdown. And even if there is a lockdown, after the lockdown is opening again, after we open, the recovery rebounds. A lot of reasons to be positive. Okay, third reason, so we are still seeing super low financing costs and very easy financial conditions. So that's going to change this year as the Fed is hiking, and that's what we think is causing a little bit of turbulence right now, but it's not going to change materially. So the Fed is going to hike interest rates, but not more as we think than what markets have priced for. Okay. Household spending is going to be up. It has declined substantially during the pandemic, and households have saved a lot. Okay, let me just show you how much households have saved. So this is basically the average savings rate through time. You can see it sits normally in the region between 4 and 6%. During COVID, a lot of stimulus added to the system, but people would not spend it. Okay? So you get a free check, but you still keep your money in the bank account. And this is changing now. It hasn't changed yet, but it has to change now because we are all keen to once again go back to restaurants and to spend money, especially if we have saved during COVID. So all of this puts the consumer in a very strong position. And we do think that once we see more and more economies opening up, that we will see more and more of the rebound. Another reason, strong wealth effects from rising asset prices. So just let me show quickly the couple of equity markets in one chart. So just the S&P, the Nasdaq, France, the UK, and the German equity market. Massive performances here for all these major indices. And what it means is actually that the household has more cash to spend. Corporate order books are full while inventories still need to be replenished. So let me just show one chart on that as well. So here we're showing in red US car orders and in blue US car production. Okay, so you can see that orders and production normally track reasonably close. So once there's more orders, car makers would produce more to be able to meet the demand. And when during COVID, we see this crash, but what we're seeing now is that US car orders are actually fully recovered. So the consumer is now willing to spend and spend more, and probably car orders are going to pick up even more. Having said that, we have this massive open gap here where car production has not been up with car orders, which it just means that from an economic point of view, companies can produce aggressively now. They can even produce on inventory just to replenish their inventories. And all of that will obviously help and make economic growth for this year actually quite easily achievable. And then the last reason is that we do think that there is massive gains in productivity. You can see that at a McDonald's, for example, there are no queues anymore because you basically can speak to a machine instead to a person at the teller. And that makes things faster and more efficient and better. At the same point in time, we do think there's a change in behavior, and that basically the balance sheet repair, which dampened growth for so many years after the great financial crisis, that's pretty much done. We've shown the chart before. The consumer balance sheet is very, very strong. Yeah, I know I've rushed through a few points very, very quickly here, but it was just important for us to get the message across why we think economic growth, at least, doesn't necessarily lead to strong capital market returns. It is a good predictor of strong capital market returns, but strong economic growth, that's definitely what we're going to expect. Okay. So one, and that's the last theme which we want to show to you, is the Fed's yield curve twist. So a lot of talk about inflation last year and inflation spiking. That actually has been definitive, I think, almost for last year. And we also spoke a lot about inflation, and we said inflation is transitory. So inflation is going to come down again. And I still claim that we have not been wrong on this theme. We might have underestimated the extent to which inflation overshoots and also the persistency of the overshoot of inflation. But at the same point in time, we also want to be very clear that inflation is going to come down throughout this year, and that's in line with market expectations. So I just want to start by showing break-even inflation. So break-even inflation is basically what the market expects where inflation is going to be over the next 10 years. You can see the market never expected inflation of more than 2.7% over the long term. Okay? We had a massive short-term overshoot, I get that, but it doesn't necessarily mean that we are wrong with our call that inflation is coming down again. Inflation will come down again aggressively, and that will also alleviate the pressure which the Fed is facing right now, because how can you not hike if you've got 7% inflation? In fact, what we think, and that's important for our message, we don't think that the Fed is on the brink of hiking interest rates. They're going to hike now, but they're not on the brink of hiking interest rates because of the 7% inflation print. They know very well that monetary policy is going to hit markets only, or the economy, the real economy also, only after a 12-month lag. By then, all the supply chain bottlenecks will have eased, and inflation will be down again. So hiking into that wouldn't make sense. So why do they hike? And that's important. They're hiking for good reasons. And that's another chart. And here we must say that maybe to some extent, we haven't necessarily been always on the right side with this one. But what I want to show in this chart is very quickly just the labor force participation rate. Okay, so this is basically the yellow chart. I'm going to zoom in a little bit on the right-hand side. You can see that the labor force participation rate has not fully recovered post the COVID crash. So we still are sitting at like an 81.6% participation rate, and this is a prime age participation rate compared to 83% pre-COVID. So that's still quite a significant gap. And what it means is that the labor market hasn't recovered to full strength. We do think, though, that this indicator needs to be taken with a pinch of salt. And that's where we must admit that we have maybe been a little too pessimistic on the US labor market. If we look at unemployment claims and continuous jobless claims, we must just admit that the labor market has been incredibly strong over the last couple of months. And that's probably what's driving the Fed to hike. So if we now look into the way the yield curve in the States has changed, and we're just looking at like 18 months ago and then the different time periods, and you can see how the yield curve evolves until basically all the way until today, you can see we've seen a massive steepening at the front end, which is basically the market pricing more hikes. And you can see that at the back end, yeah, the curve moved up, but it did not change materially, okay? So a flattening yield curve like that is not necessarily a good indication. Like last year, our theme was a steepening yield curve is good. And that actually played off quite nicely because it was this time when we were basically looking from something like that into something like this. So steeper yield curve, positive for markets, and that theme played out nicely. On the contrary, now we would have to say, okay, this yield curve flattening now, maybe that is bad news. And the reality is, to some extent, it normally would, but one once again must take a step back and look at the different drivers of the flattening yield curve. And again, we do think that this has mostly been driven by this very, very strong labor. Okay, a lot of macroeconomics, a lot of themes. Yeah, we would like to take you through everything, but obviously, as always, we are running out of time. So I want to rather take the opportunity and hand back to Rupert to maybe take us through our current investment views.
Great, thanks. So how do we tie all of these views into what we have a view on at asset class level? So how does this macroeconomic picture fit into the asset class views for which we are specialists in? So in the multi-asset space, we have all of these asset classes on the menu, and our job is to try and guide investors through these asset classes, taking tilts away from the long-term strategic asset allocation of whichever fund it might be. So a high equity fund having a high equity allocation, that means that we would tilt, for instance, from 40% to 45% in South African equities if we see South African equities as being attractive, which ironically we actually still do, and I'll take you into that in a bit more detail. But just going through the asset classes in general, what we're seeing, Bastian mentioned earlier, was that we've got a strong overweight in South African equities, a strong overweight in nominal South African bonds, a strong overweight in South African inflation linkers, and a strong overweight in the rand versus the dollar. So a very optimistic picture on South Africa. Whether that is perhaps too optimistic is an interesting field for discussion, but I'll show you how our models update in real time and would reflect a change in that level of optimism in the markets, which would then change the positioning of our multi-asset funds to reflect that as well. Looking abroad, we've got a neutral market in the United States. We've got a neutral emerging market, and then we're looking at a bit of value emerging within developed market and emerging market small caps. That is, however, something that is prone to being an underperformer in a big risk-off event. So we're cognizant of that one. And then within the bond space, we're seeing neutrals on US offshore bonds. European bonds, we're seeing a strong underweight, so not much on offer there. And then emerging markets, we're seeing neutrals again. And then in South Africa, within the real asset space, we went through a cycle last year where we were bullish on property, captured some of the upside, and then went back to neutral, took off that trade, and have since banked that P&L. So just going into the difference between South African and US equities at the moment. I think that tells quite a good story, which ties in with the story that we've been telling you about at the macro level. So within South African equities, we are strongly overweight. The signal is right on the margin, you'll see, between strong overweight and moderately overweight. And what we've seen as a time series of exactly that view is we've been at strong overweight through 2021, got some really good alpha printed within the fund based on that. And we're looking now at the possibility of the South African equities strong overweight coming off. What might drive that? Well, we've got a bunch of our, well, the summary of all of our views in these factors over here, where we look at the asset class from 4 different pillars: valuations, economics, financial conditions, and sentiment. If these are attractive, we take a strong overweight. If these are unattractive, we take a strong underweight. What we're seeing is a bit of a mixed bag within the valuations space for South African equities. That's something that's new. The value case has started to disappear with the strong rally in South African equities over the last year that we've seen. But we're seeing still strong financial conditions. So that's stimulus from the Fed, both through rates and through quantitative easing. I mentioned that these factors do change very quickly. That's one example of one which would change very quickly. So when the Fed starts to tighten monetary policy, then we would see that indicator change. And that's why I mentioned that overall, this signal might very well change back towards a neutral signal in the not so distant future. Just to compare that to US equities, where we stand at a neutral at the moment, that is a case which has persisted for now 2 or 3 years, where we've seen this valuations perspective, which is extremely unattractive, but financial conditions which have been propping up markets. So that's just money flooding into the markets, people not knowing what to do with that money with rates so low, so they start to buy into US equities and propping up the markets. That asset class may very well downgrade if financial conditions do deteriorate down into a strong underweight, at which point we would then downweight our allocation towards US equities. So just two different sides of the coin, but the same general macroeconomic picture, which I think reflects the themes that Bastian and I talked about earlier, where if financial stimulus were to shift downwards or growth were to change in a downward direction, we would expect these indicators to shift downwards and us to go into a general risk-off scenario within these funds. So we capture all of those different types of indicators, and we are continuing to do research on more indicators that we can add to the models, but that's just the general mechanics of how the funds work in the multi-asset space.
Yeah, so general mechanics, that's a good word, to good opportunity to basically recap exactly what we are actually trying to achieve and how this fund, this Prescient Balanced Fund, once again operates in detail. Having said that, before I go there, we obviously follow exactly the same concept in the more defensive space. So we have a fund called Prescient Defensive, which is achieving the same story, but in the low equity space. And then we also have a fund which is called Prescient Global Balance, which once again is following exactly the same concept, but now pretty much in the UCITS framework, so offshore. So we've seen quite a few indicators on the brink of becoming more conservative. So you can see the model which updates daily, and where all this information coming up every day is processed, is getting a bit more nervous. Not blue skies everywhere as we saw it through 2021. So the question now is, well, now the market is crashing. Are we too late? Well, no, we're not too late, because these indicators are all tested, and they're all tested for statistical significance, and they're all tested for their ability to have predictive power. So all the vectors which are performed are updating daily as well, and we only use indicators where we have statistical evidence that they have a meaning for the returns, which we will see in the future. Okay, so probably we'll turn slightly less optimistic over the weeks to come. But again, it's not necessarily about market timing, which doesn't work. So if we are a week or two late, it doesn't matter. We will capture the right and the bigger moves. We've done that through the COVID crash, where we generated alpha. We've done that through the COVID recovery, where we generated alpha. We are not here to time the market, and that just evidently doesn't work. Okay, but enough about the indicators and the system. Quickly, just a very quick recap of the concept. And I mentioned already, we do this not just for Prescient Balance, but also for Prescient Defensive and within the global space. We start with a dynamic strategic asset allocation where we continuously update for structural breaks. That what you can see on this chart is the strategic asset allocation of our balanced fund. You can see it's a comprehensive allocation. It's well diversified. We do invest also in infrastructure, in SA high yield. We invest in clean energy fund. So it's all of these scarce asset classes, which are not so easy to get hold of. We run them with in-house teams and you access them at zero costs. So just to highlight, we charge 30 basis points on a top level, but then we are obsessed with keeping the costs low. It's an comprehensive asset allocation, although in the way that we have a 30% offshore allocation, but we also engage in currency hedging, which you can see in the outer ring. So all of this is not too different to an ordinary high equity balanced fund. We don't want to be too different, but we want to be slightly better, again, to consistently be better than average. And this is exactly what the first reason why we're achieving it. Secondly, we have tactical asset allocation tilts in place once there is high conviction. So we can prove that our tactical asset allocation tilts have worked in the past. They have contributed positively, not massively, not to the extent that we would be shooting out the lights. That's not the aim. Last year, we had a positive contribution. The year before, we had a negative contribution, but it is in the basis points. And overall, it adds to our risk return profile. Okay, this is where we process, and these are all the models which Rupert explained. This is where we process all the information and make sure that we have an edge. Third point, and that's almost my last point, but those are the three good reasons why we are ahead of the pure passive and why we can compete with other, actually outperform other active funds. We have portable alpha. So instead of stock picking, we do port fixed income alpha, fixed income, the area where we are known to be good. We port fixed income alpha onto our equity building block. And through this approach, we are now almost 8 years old within the balanced fund, 8 years of positive contribution for positive alpha from our fixed income building blocks and from our portable alpha. So what that means is never a year where we would be shooting out the lights, but every single year, again, a little bit better than average, taking us to the top over a period as short as 3 years. And then last but not least, if you buy nothing into anything which Rupert and myself presented on, we think our fund is a good offering because it has very low fees. Okay, so we, again, I mentioned 30 basis points management fee, but our TIC is in fact actually lower than some of the pure passive. So if we just take some of the usual suspects here, you would see that our TIC is lower. So on the y-axis on the left chart, we show the 5-year return against the TIC. On the x-axis, we've done that before, but on the right-hand chart, maybe we focus on that chart now. We actually once again plotting the TIC on the x-axis. But then now on the y-axis, we plot the time which we are ahead of the peers, so ahead of the average fund on a 1-year rolling basis. And that's where we are literally ranking #1 in the category. And those are the stats which we've been quoted on by Citywire and which also Mayer and Rupert spoke about in his introduction. Okay, cool. So that's basically our story. I'm just going to go very quickly into fund performance, just show 1 or 2 last charts when it comes to Prescient balanced, nothing major. I just want to once again speak about the peer performance or the absolute performance as well and how we gotten there. I mean, I could now literally go through all the individual years. We've done the 3-year before. I'm not going to go through the individual years, don't worry. I'm not going to bore you too much with performance. But if I look at something like 2 years rolling, you can see already that over a 2-year roll, it's a bit of an odd period. I'm just picking a random one now. Over a period as short as 2 years, we've never dipped into the 3rd quartile. Here we already always better than average and mostly in the 1st quartile. Let me take a more meaningful period, 5 years. You can see on a 5-year period, if we rank all the funds in the category, we are really, really far up, basically almost like right at the top. We're going to go there soon, I'm pretty sure. And I want to also then in this context highlight the consistency here around these funds once again. So show that rolling alpha, the rolling ranking through time. You can see 5 years, we've never dropped out of the 1st quartile. Very, very consistent in the 1st quartile. And yeah, actually very consistent in the 1st decile. And yeah, as confident as we sound, but just we have so much trust in this process. We don't expect these numbers to change anytime soon. Let me just give you one last chart, and that's again on performance, and then I'm really calling it a day. We are ranking the different, on the x-axis now you can see the different periods, 3 months, 6 months, 12 months, 3 years, 5 years, and 7 years. And then in the different colors, you would see how often we would rank within a certain category. So if I look at the last quartile performances, you can see at the bottom of the page, very seldomly we go into the last quarter, but it does happen over 3 months and 6 months periods. Over 1 year periods, it already doesn't happen. Okay? Third quartile performance, it does happen. Very seldomly, though, over 3 months it happens, over 6 months it happens, 1 year, very, very seldomly, yeah, almost gone. And then if I go second quartile, that's what now basically starts to build. But if you check first quartile performance, the longer I go, the more consistent. So everything's from 3 years off, you have a hit ratio of 90%. And then if I go like 5 years, sorry, much more than 90%. So if I go, it's 93% if I go for 3 years, and if I go 5 years or 7 years or anything longer, only first quartile performances. Okay, so yeah, that basically takes us to the end of the presentation. Obviously happy to take questions if there are any. Otherwise, yeah, back to you, Mayor, and thanks for having us from us.
Thanks, James. As always, quite interesting to see our views. I don't want to I don't think I can overemphasize the story on consistency. Apart from the fact that consistency kind of enhances our ability of predicting the future in a sense, and therefore reduces our probability of being disappointed. I think the important part for me is to appreciate that if one can consistently deliver positive results, it manifests in long-term compounding. And that is a hugely powerful phenomena in investments, as we all know. So often, you know, we are distracted by seeing other propositions performing extremely well over the short term, when we switch around, and that is certainly the most, or the easiest way to just destroy value. So we've seen here, by being consistently compounding positive results, I mean, you end up in the top 10% of funds in a sector. And that is a good outcome. That's a good outcome for all clients. And just to kind of, again, mention that, you know, the balanced fund is managed in this process, our defensive fund, exact same process, our global balanced fund in the UCITS space, same process. And then our equity suite. I mean, in the balanced fund, we use a blend of the ALLS and the CAT SWIX in our equity suite, but we run products on the SWIX, on the top 40, on the MSCI, and soon to launch MSCI emerging markets. So we can basically use the same process on any replicable index, whether it can be all bonds or property index or anything. So it's really a sustainable and robust process. And again, then lastly, I mean, one word you'll hear a lot from us is evidence. So we base everything we do on evidence, and evidence need to statistically support our decisions, not just evidence, perceived evidence of happenings around. We really need to test these things to see if we can build a theorem around the evidence that we see. And only then does one get the statistical certainty to construct your portfolios and remove all your human biases and remove all your kind of predictions and feelings, and deliver truly scientific results that are meaningful. Okay, but in any case, that's it from me. Let's look at a few questions. I'm just going to run them down as I kind of read them here. First one on the COVID story. I think there are different views on this, but what do you ascribe to SA's low COVID infection rate versus countries considering our low vaccine take-up?
I'll take that one. So, geez, there are a lot of theories around that one. So we could go down a slippery slope, but I think from my personal perspective, I think South Africans are just a more hardy population. We have a lot more vaccinations, ironically, at a lower age. So things like polio, etc. We're exposed to a lot more viruses which are similar to a COVID variant throughout our lives. And we also are more spread. So in many cases in South African geographies, people are a lot more spread than, for instance, taking a tube to work where you've got 100 people on a very clammy, stuffy tube in London, and you know, that's a super spreader event just waiting to happen. But I can only speculate there. I really can only.
Thanks, Rupert. I mean, I stand to be corrected, but I think I might have seen 100 oaks in a taxi before as well. Okay, on interest rate hikes, 3 to 4 rates expected in the US may tackle inflation nominally, but US consumers and spend will come under pressure, negatively impacting investor sentiment on top of very elevated stock prices.
Yeah, that's a very, yeah, I love this question because it speaks exactly to our process. So there's a little bit of speaking about rate hikes, which we would call financial conditions, and we're speaking about impacting sentiment, which is relevant, and we're talking about elevated stock prices, which is relevant as well. And I mean, Rupert presented on our market views, and we are combining 4 factors. It's valuations, economics, financial conditions, and sentiment. So exactly what is asked here, those are the indicators we use and which we would statistically assess and which we would test for their predictive power, and then we would blend them together to tell us where equity or bond markets will go. And yeah, it's a bit of an open question. So yes, we do think 3 or 4 rate hikes to come. That doesn't necessarily mean that financial conditions are overly tight. Remember, financial conditions are also driven by stuff like tight credit spreads, which is good for equities, tight cross-currency basis, which is good for equities, no funding pressure. If I look at the banks, they've got ample liquidity, which is good for equities. So one must not just focus on the US itself, and we must see what it means. And then also the impact on the consumer is also difficult this time because the consumer has saved so much cash. So probably he can do away with slightly higher interest rates, but we will have to see. So our indicators, we even go as far as looking into Google Trends analysis. So we see exactly what the consumer is Googling for. We see how the consumer is feeling on a day-to-day basis. If our indicators start to turn, we turn our positioning. So we do expect that we will get all these informations in a timely manner, but yeah, good questions, a lot of different ways to answer it, and no perfect answer from my side, but yeah, let's observe and go with the evidence.
Good. So here's one that's bodes itself to quickly explaining our equity process. So the question is that we are overweight SA. Is that on SA Inc. stocks or Rand hedges, or more specifically SA bonds?
Okay, so we like SA for different reasons. So we are overweighting SA bonds. We are overrating the Rand. We are not overweighting SA Inc. stocks. So when it comes to our equity process, we rely on portable alpha. So we would not stock pick, and we do not go for sector allocations. Okay, so what we do is we get our equity exposure on an index level, and then we port on top of that fixed income alpha. Okay, so we basically get equity beta and fixed income alpha, which is to us kind of like the best of both worlds, because you get long term the beta, but stock picking is difficult. And yeah, even that call, SA Inc. stocks or not SA Inc. stocks, I wouldn't want to make that call. So we go with the index, we port a few basis points fixed income alpha on top, and then we outperform the index, and then we outperform 80% of the equity managers. At this point, I mean, the question is hopefully answered with that. I saw in the chat also a question at the bottom, which point on the US bond curve do you target? So that's another good question, which I just want to wrap into this one because we're speaking SA bonds. So we are strongly overweight SA bonds. And because of that, we are obviously long duration. Which point of the curve do we choose? We actually like the most duration. At the same point, you get the highest level of convexity. Okay, so basically what we're trying to say is max out your duration, max out your convexity. As we are so bullish, it becomes an easy call. We obviously also take into account total returns, like a roll down on the bond curve, where the curve is steepest, etc. But these factors are actually outweighed right now by our bullishness, which means we want max duration and we want max convexity.
On the equity selection again, I mean, in our TAA especially, but I would imagine it would be wider than that. Do we consider style as a factor in SA versus offshore equities?
Yeah, so another good question. I think goes back to Bastian's earlier point where we have these 4 pillars which we analyze. So one of them is valuations, and then another one, which is economics, is essentially growth. So we look at both of them simultaneously. And then if we go a step further, if we were to take style within equities as being a market cap, for instance, we have allocations towards large caps, and then we also have an asset class small caps. So I'd say, yes, we do consider style. We just consider style from all angles possible. Yeah.
Okay, then there are a few questions on TAA, and they basically all refer to market indicators, which we obviously know are very dynamic and ever changing. And the question is, how do we manage to avoid whipsawing? Or the second one around that is sorry, where's that one? Is our terms of implementation of changes, how many changes have we had in the last 3 years, for example, in our TAA model?
Let me start with the second question first. It sounds quite aggressive, but there's no lag because there's no monthly rebalancing. So we literally rebalance the funds on a daily basis. So a moderate or strong overweight in SA equities, you could see the indicators on the brink. It actually gets updated during the day. As soon as we move into a cost benefit analysis, how quickly they can implement the new position, and then they will go for the check. No problem for really shift from many shifts have there been over the last 3 years? Well, I don't have the exact number, but we are quite active. Some of our indicators are updating daily, some of our indicators are updating monthly, some of our indicators which are more like long-term macroeconomic might only update quarterly. But yeah, we can trade on a daily basis, but for SA equities, for example, we overweight now for a year. It's only now that we're looking into changing that. SA bonds, we overweight for a year. And it looks like we're going to be overweight for another year on SA bonds. We're still strongly overweight on the rand, that's on the brink. Property, Rupert gave an example. We were strongly overweight post-COVID. We moved into neutral, actually moved into an underweight for a short period of time and then back into neutral. So it depends so much on the moving parts. We do think that we have the right frequency and we obviously would test for that. And obviously we would be obsessed with keeping transaction costs and trading costs low. And then lastly, just on the whipsawing, there's never a guarantee that you avoid whipsawing. If you can make your model more static or less dynamic, then you avoid the whipsawing, but you also get natural lag and you just are able to react faster. Okay? So we have a lot of smart tools where we use exponential moving averages on certain indicators where we smooth them to some extent. All of that works in an econometrically sound way. So we would always test that this is the right combination of lagging or leading or smoothing, so that there's predictive power on what the output will be to the economy, but then also on financial markets. So trying to get that right in a very econometrically solid way. But to be honest, you never have a guarantee. I think every model, once you make it slower, it becomes less whipsawy, but it's also slower to react. So trying to strike a balance econometrically.
Listen, we're running out of time. Just maybe 2 last questions on interest bearing. If you can just answer these in a concise manner, please. Which area of the yield curve do you find most attraction in the bond space? And what is the duration of the SA nominal bond component in balance fund?
Yeah, so we had that already. We go right to the back end. So we would literally max out duration and max out convexity. So we hold the vast majority in the R2048s and in the R2037s. We also hold some inflation-linked bonds, but they would also be at the back end of the curve. So if you ask me on the duration, we are close to 3 years longer than the OLV, and that's where we are very comfortable at right now.
And then just finally, does increasing interest rate environment increase the potential to generate portable alpha?
Yes and no. So the pure fact that interest rates go up do not necessarily indicate that there's a better opportunity to generate portable alpha, because our funding costs also go up. Having said that, the slope of the yield curve has a massive impact, and especially in the local space, we're seeing an extremely steep yield curve, actually at the front end as steep as it gets. We're literally seeing a yield curve which has barely ever been steeper, and that is very, very beneficial for our ability to generate portable alpha, because we are investing in a 12-month asset and we're paying the rate for a 3-month asset, and the gap is very wide, and that's what we earn. So very, very attractive environment when it comes to portable alpha right now. Hasn't always been that over the last couple of years, but right now it is very, very attractive.
Okay, thanks for that. And to all the attendees, thanks very much for spending some time with us. We look forward to seeing you again, all virtually at the end of in 3 months' time. And last message I want to leave with you is be wise, make the right decisions, because it will pay off in the long term. Have a great day. Thank you.
Thank you,
Thank you.
everybody.
Thanks.
Cheers.
Thanks, guys.